What's up everybody, Nate here, and one of the largest real estate investing firms in the world is currently taking a massive hit from the slowing economic conditions in the housing market. Now, we have seen a ton of other real estate investment companies like Zillow and Realtor.com take big hits this year and lay off thousands upon thousands of their workforce, but it is a little bit different when one of the largest asset managers in the real estate and housing market suddenly starts to show some troubling signs. Now, the firm in question here is Blackrock. Blackrock is one of the largest real estate investing firms in the world with hundreds of billions of dollars in property ownership all across the world. But they suddenly put a major pause on one of their real estate investing products. This basically signals a slowdown in the larger real estate market as millions of real estate investors are starting to pull out. So what exactly is going on here? Well, Blackrock has a model with one of their investing programs called REITs. A REIT is a real estate investment trust, and it basically gives millions of investors the ability to invest in real estate without actually owning a property. So it's a really passive way to earn income. It's a passive way for somebody to own a property. It takes away all of the management. You basically just own a share in the REIT, and the REIT owns those properties. You will get all of the benefits of owning real estate without all of the headaches of actually managing the property yourself. So you don't have to deal with tenants, you don't have to deal with cleaning it up or fixing toilets, you don't have to deal with any of the really high pressure stuff. You are just going to be investing money into the property, and this is a win-win for both parties because you are giving them the money to support the property and they then have money to actually manage it. Now, you're probably thinking, well, if you don't actually do anything for the REIT, then how exactly do you make money? Well, it's very similar to owning a stock. When that real estate investment property does really well and continues to appreciate in value, all of that money is then redistributed to all of the shareholders via a dividend. REITs have to give out a huge percentage of dividends every single year in order to be classified as a REIT. So this is where we come in with BlackRock. BlackRock has billions of dollars worth of REITs all throughout the country, but the problem that they're facing right now is they just had to put a pause on redemptions for their REITs to the tune of $69 billion. Now, what exactly does that mean? Well, those redemptions are basically like the dividends, right? So now these investors are trying to get their dividends, they're trying to get their shares out of all of these BlackRock properties. But if BlackRock sees that this is happening way too much, there's too many investors pulling their money out all at once, and that kind of triggers something in their system and they put a temporary pause on it. So basically what we're seeing is a $69 billion pause on the redemptions and the pullouts for a lot of investors. Their money is frozen there because if they pulled their money out all at once, that would essentially cripple BlackRock. So BlackRock is not letting it happen and they're putting a pause on it. So why exactly are real estate investors pulling their money out now? Well, real estate investors are kind of reading the writing on the wall and they're realizing that really high interest rates and property values going down throughout the country means that they're not going to be getting as much money. And the REIT values for a lot of these investments through BlackRock are also starting to lose value. The Federal Reserve all throughout 2022 has been raising its interest rates very quickly and aggressively, and that might continue into 2023, meaning that your valuations for real estate properties and the return that a lot of these REITs are going to give investors are going to be a whole lot lower. So investors are taking their money out and trying to get away before things go way down. It's the same exact reason why we saw Zillow and Realtor.com cut a lot of their staff. It's just from the business perspective, right? They're cutting a lot of their staff so that way they can save money and survive as a business. They don't know what's going to come in the future, but they know right now that mortgage demand is at an all-time low because interest rates are much, much higher than they've been for pretty much the past 10, 15, and 20 years. All of this is linked to housing affordability, which again is at an all-time low. Buyers in the United States simply cannot afford to buy a home right now, and that means that they're not going to be able to rent a home either because, well, if a lot of buyers can't buy a home, then they go to renting, whether it's a home or an apartment. And the renters market is also extremely oversaturated in the United States right now, with buyers being pushed into it because the housing market is way overinflated in value. So basically what all of this means is that you have really, really low demand in the housing market and you have supply that really isn't picking up either. So you have a situation where prices prices are basically forced down, and real estate investors do not know how low it's going to be. They have to figure out now, well, is this just a slow slide downward to 15 and 20% price drops, or are we going to reach the bottom at some point? And all of that is going to be dictated by the Federal Reserve and their interest rates. And to be completely honest with you, I don't really know what exactly is going to happen next with the housing market in terms of what the Federal Reserve is going to do and if buyers are going to come back in. It looks like right now the Federal Reserve is going to continue to raise its interest rates aggressively and quickly into 2023 because we still have a really strong labor market and prices and inflation are still much too elevated in our economy. So the Federal Reserve has to use their monetary tools to bring that down, and that's going to continue to put a damper on the housing market. The higher those interest rates go, the fewer Americans are simply going to be able to afford homes. Now, this whole Blackrock situation is not catastrophic, it's not a crisis, but it is just a peek into the potential that we could see into 2023. Real estate investors and investors in general are on the forefront of pretty much all of our economic conditions because they are the ones trying to make a profit off of basically everything, right? So if they can't make any money in something, if they're suddenly pulling out, that means that that industry might be drying up, and that is a bad sign that eventually could trickle down to everyday Americans. Investors want to make a profit, they want a return on their investment, but they can't get that if housing prices are going to be going way, way down in the future. They want to avoid a situation where now they have this asset that is no longer bringing them in any money. If we still see really high interest rates into 2023 and we see higher unemployment, fewer Americans are going to be able to afford homes, meaning prices are going to come down even further, and that means rents are also going to go down for real estate investors, so they want to pull their money out. They don't want to hold on to these properties anymore. And it sort of triggers a larger economic event, right? Because now if you have all of these assets being sold off and pulled away from firms like Blackrock, well, then we can probably guess that it's going to happen with some of your other large real estate investing firms throughout the country. And the thing that you've got to remember here is these real estate investment firms are not by themselves, right? They don't just invest in real estate. They have a ton of other assets and they have a ton of other string of webs into other financial markets and into other businesses. So that hundreds of billions of dollars worth of assets, if it were to topple, could eventually start bleeding and infecting other industries throughout the United States. That could turn out to be a huge problem, similar to what we saw during the 2008 great financial crash with Lehman Brothers and Bear Stearns. Now, again, I'm not saying that we're going to have an outright crash in the housing market at this point, but what I'm saying is that real estate investors are trying to figure out and prepare for whatever is coming next. They want to protect their money, and again, they don't want to be holding a bunch of real estate, and they don't want to have a bunch of shares in these REITs if they're not going to get a good value for their money in return. So they are selling off, and that could have big implications for the broader economy and, of course, the housing market. And to put it in perspective for you, there really isn't a huge opportunity for the housing market to actually go up and to actually start massively booming into 2023. I mean, with the Federal Reserve raising its interest rates and with a slowdown in spending in our economy, all of those things basically indicate that our entire economy is going to be slowing down. And if the entire economy is slowing down, then the housing market is also going to slow down. This is all designed by the Federal Reserve. They want inflation, they want prices to come down in the housing market so more people can buy homes and that we have that equilibrium between supply and demand again. We're starting to see in the top 10 biggest real estate regions in the United States, prices dramatically come down. Now, part of the reason for that is because we don't have a lot of supply and prices were way, way heavily inflated in those areas. You're not going to see huge fluctuations like that throughout the country, but with those areas starting to come down, that signals to the rest of the market that prices may have finally peaked throughout the United States. And if they've peaked, then there's no reason for investors to continue to pour money into that market. The Federal Reserve has talked about slowing down its interest rate hikes this month and into 2023, but we don't know if they're going to do that at this point. And based on the other things they've said, interest rates could stay very restrictive and high next year. And that's the thing that you have to ultimately remember about the housing market at this point. Prices over the last couple of years, they went up like crazy. There was lots of money printing, and interest rates by the Federal Reserve were at around 0%. So we had millions of people suddenly flowing into the housing market very, very quickly. You had this upward crash, right? You had millions of people buying homes faster than we pretty much have ever seen. That meant that prices were going to go way up because supply just couldn't support that many homes. It was definitely a seller's market. People were bidding on homes by the dozens, and you had all of these sellers making a killing on their houses. Some houses were selling $50,000 to $100,000 plus above asking. But now the economic conditions have changed, and now we're having that reverse crash, and everything is kind of contracting, meaning now you only have maybe 1, 2, or 3 bidders on a house, meaning it's a buyer's market. And when you have a buyer's market, that means that the house is going to sell for whatever the buyer wants it at. Naturally, prices are going to come down in that light. Now, how far they actually come down, again, it really is just going to depend on a lot of economic factors. This whole situation with Blackrock could finally signal that the housing market bubble is finally ready to pop. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.